Hello students, welcome to the online classes of Cerebral Institute. This video on financial statements part 1 without adjustments is brought to you by Cerebral Institute Sparking Imaginative Learning. In this particular video we will discuss about the financial statements, the types of financial statements but without adjustments. So here we go. The first question that comes in our mind is, what is financial statements? A simple answer is, the financial statements shows the fair or true financial performance of the business. It is of two types. First type is income statement, that is your trading and profit and loss account. Second is your statement of financial position, popularly known as balance sheet. We will discuss each and every aspect of trading and profit and loss account plus your balance sheet. Okay, first of all, we'll discuss about the trading account. Trading account is what? It includes all the direct expenses or direct incomes. Here, what is direct expenses or incomes? All those incomes, all those expenses which are directly concerned with your business or firm. For example, your purchases, your sales, your opening stock, your closing stock. These all, entries have direct concern with your firm or your business, right? So here is this specimen. We have debit side, we have credit side. In debit side we are having opening stock, purchases minus return outwards. Return outward here means purchases return, wages, carriage inward, gas, fuel, power, freight, cartage, etc. etc. You can include this import duty, your dock clearing charges, factory expenses, manufacturing expenses, etc. Your gross profit, right? In credit side you have sales minus return inwards. Return inwards here means your sales returns, closing stock and gross loss. Here gross loss and gross profit is what? It is your balancing figure, and this gross loss and gross profit will be included or shifted to your P&L account. Okay, we move to next. Example is, we are having opening stock. It will be included in the debit side of the trading account. Purchases, debit side. Sales, credit side. Freight octroi, debit side. Wages, debit side. Factory lighting, debit side. Coal, gas, water, debit side. Purchases return, it will be subtracted from your purchases. Sales return, it would be subtracted by your sales. Carriage on purchases, carriage on sales. Here carriage on purchases will be included in the trading account. Why? Because in trading account we will include carriage inward, not carriage outward. So carriage on sales will not be included in the trading account. It will be included in your P&L account, debit side of P&L account. Factory rent, your debit side of trading account. Office rent, debit side. Import duty, debit side. Here we have closing stock. Closing stock is your income actually. So it will be shown in the credit side of your trading account with sales. Fine. Okay. Next is your profit and loss account. Profit and loss account is what? It includes all your indirect expenses or indirect income. Now, what is indirect expenses or indirect income? All those incomes, all those expenses which are indirectly concerned with your business. That means all those entries which are not included in your trading account, it will be shifted, it will be included in your P&L account. We are having gross loss and gross profit. If you are having gross loss in your trading account, it will be shifted in the debit side of the P&L account, and vice versa. If you are having gross profit in your trading account, it will be shifted to the credit side of the P&L account. Very important point to be noted. Okay, salaries, debit side we will include salaries, rent and taxes, advertisement, bad debts, discount, depreciation, etc. etc. Net profit. And the credit side we are having rent received, commission received, bad debt recovered, interest, discount, etc. plus your net loss. Okay, in debit side we are having all the payments, and in credit side we are having all the receipts, incomes. Okay, Your this net loss and net profit is what? Again your balancing figure, and these two will be included, will be shifted directly to your balance sheet. Fine. Okay. Example. Okay, we are having opening stock. It will be included in your trading account, debit side of trading account. Purchases, trading account. Sales, trading account, credit side. Purchases return, it will be deducted from your purchases. Sales return, it would be deducted from your sales in trading account. Wages, trading account. Advertisement, indirect expense है, it will be included in your P&L account. Salaries, P&L account, debit side. Again P&L account, debit side. Commission paid, you are paying, that is your expense. It will be included in your debit side of P&L account. P&L account, but in the credit side. Why? Because it is our income. We are receiving commission. Traveling expenses, P&L account, debit side, P&L account, debit side, P&L account, debit side. Dividend, dividend will be included in where? It will be included in your this credit side of P&L account, right? Because it is your income. Printing and stationery, P&L account, debit side. Again P&L account, debit side. Why? Because it is your loss. Carriage outwards, it will be included in the P&L account, debit side. If it would be your carriage inward, then it would be included in the trading account. Okay. Loss by theft, again debit side of P&L account. Gain on the sale of asset, it is our income. It would be included in your credit side of P&L account. At the end we are having closing stock. It will be included in your trading account. Very good. Credit side of trading account. Next is balance sheet. Balance sheet is what? It is a statement of assets and liabilities. In your debit side we are having the liabilities, and in our credit side we are having our assets. In liability side we are including current liabilities, fixed liabilities, current liabilities which can be converted into cash within a year, highly flexible. Okay. Sorry, current liabilities are what? It can be paid. Sorry, liabilities is what? Those things which you have to pay, right? So current liabilities are those liabilities that can be paid within a short period, right? Fixed liabilities, long term. Then we are having capital plus net profit minus drawings minus income tax minus life insurance premium. In capital we will add net profit, we will subtract net loss, we will subtract drawings, income tax and life insurance premium. Current assets that can be converted into cash in a short period, highly flexible, highly liquid, right? And we are having fixed assets, that means they are fixed in nature, like furniture, loose tools, plant and machinery, goodwill, etc. So at the end of the balance sheet your liability side and your asset side should be equal. If there is any discrepancy, that means your sum is wrong. So the point to be noted is that your liability side and your asset side should be matched. They should be equivalent. Okay. For example, we have plant and machinery, asset side पे, land and building asset, furniture asset. This is your what? This is your liability. Debtors asset, creditors liability. Bills receivable asset, bills payable liability. This is your asset, liability, and liability. Solution, we'll take a look on this. Thank you. For more videos, kindly subscribe Cerebral Institute.